Hey guys, I hope you're all keeping well and safe. So a few weeks ago, I shared my Trading 212 Invest account, which I mainly use for active stock selection, stock picking. And even though I am a long-term investor and most of my investments are in funds and ETF, using an ISA account with Hargreaves Lansdown, I use Trading 212 mainly for a bit of fun. And as investors or people who are into investing in the stock market, it's always exciting to invest in single stock because your potential upside or downside could be quite big compared to when you invest in a fund or an ETF. So the first time when I shared the video with you guys, I wasn't really sure whether it's going to be helpful to do this on an ongoing basis, but some of you have encouraged me to do that, which I'm planning to do now. So in this video, I'm going to share with you what has happened over January. I sold 3 stocks and bought 3 more new stocks in the portfolio. It still stays pretty punchy, pretty high risk, and very concentrated. But yeah, let's get started. So in alphabetical order, the first on the list is Alibaba. I spoke quite a bit about this company over the last few weeks, and so there's nothing kind of new to add on Alibaba. I am still a happy holder of the company as an investor, but yes, it does have quite an esoteric political risk attached to it because of the Chinese government. What the Chinese government is currently doing, if I'm thinking honestly, it doesn't shock me, but in my humble opinion, it does not seem to be a good thing to do for from their perspective, because some of the Chinese companies have already been banned by Trump's executive order, and they have been dropped from biggest market indices like MSCI and FTSE, while this company like Alibaba, it's not on the list of companies that were banned because it does not have any tie with the Chinese military. But what the government is doing with the company and Jack Ma and so forth, without getting political, it is deterring a lot of investors, especially retail investors, away from investing in this great company. And in my humble opinion, if China does want to kind of hold itself or hold its currency to a bigger value and compete against the US dollar, coming from a currency reserve perspective, this does not seem like a great thing to do, because they do need to attract foreign capitals, and foreign capitals comes from people like us who finds interesting opportunities in their country to invest in. Well, it is what it is, and there have been some positive development actually on that front. So and IPO, they have come to some sort of agreement with the Chinese regulators, and they are reapplying for the IPO as a financial company so that it can get approved and go ahead. That should be quite a positive news for Alibaba. The stock price of Alibaba has been tiptoeing at certain bounds over the last few weeks, and we really do need some sort of positive news to break that resistance point. And I hope the days are better for Alibaba. So I'm just holding on and hoping for the best. By the way, I did do some DCA with this stock, dollar cost average, as it was getting weaker over the last few weeks, which is why the overall return is rather positive. It wasn't like this a few weeks ago if I hadn't bought more stocks in this company. After Alibaba, we have Apple. I'm still holding on to it. My only regret with Apple is not buying enough unit. I wish I bought more at that price. And even though I think it's a great company and I want to hold more of Apple, I don't know, I think I'm just making a silly mistake of not wanting to buy more because I don't want that to impact the average price paid for Apple. That's just a silly thing to do. But anyway, at the current price, Wall Street is quite cautious on this stock, just based on the valuation and the market price. So maybe we can expect to see some correction. And if that happens, I will probably buy some more of Apple. But anyway, it's up 21% since I bought it. And I do have a negative FX of 5.8% just because of the stronger pound. Next alphabetically is BAE Systems. I have not bought it. This is my first free share that I got because I think someone used my link from the description box below, which was really great. So thank you to whoever's done it. I usually don't promote it or talk about it, but there is a link in my description box under all the videos in YouTube. So if you do open an account with Trading 212 because you want to, you can use that link. And if you use that link, both of us get a free share. I mean, everyone's got that link. It's not just me. So whoever's link you use, you will both get free share. So if you are thinking of opening an account with TradingJohn2, you might consider using a link rather than just opening it on your own. Next, we have Barclays. So I have actually bought Barclays last month. I paid about £1.45 per share. This was pretty much, you can say, like a value add or like a value play in my portfolio, and I have mainly added it to get a bit of diversification benefit. Although I am a growth/quality investor, so most of the PE ratio in my stocks that I hold, they are really high, like extremely high. But Barclays, it seems like a good little thing to add. So as I've mentioned in some of my previous videos on the themes that I think will do well when the COVID situation starts to improve. So basically through an economic recovery, banking sector or financials, they're strategically well positioned to do well when the economy starts to rebound, which is why I was thinking of adding some exposure to UK bank. And I have done some comparison across all the other UK banks within FTSE share, and Barclays Bank kind of seemed to be a bit better positioned compared to the other banks. One of the ways that I compared Barclays with the other banks is looking at their rate sensitivity. So how much of their revenues are coming from interest margins. As many of you would know, banks are extremely sensitive to interest rates. So when interest rates are higher, it's really good for banks, and when they're low, it's not so great. And that is because when banks lend out money as loan to the customer, they tend to charge you higher interest cost. But when you sort of put your money with them in the bank, they pay out a very low interest cost on your savings account. I think we're all pretty much familiar with that when you look through our bank statements. So this is basically how they make money. So as an investor, when you're buying a bank stock and you're looking at their balance sheet, the assets would be all the money that they have lent out as loan to customers, like say mortgages, for example. And the liabilities would be the money that we have put in the bank as deposits, because it is essentially our money and it's a liability for the bank. So the interest that they charge on the loan and the interest that they pay out on the savings, if you do the difference of the two amounts, this is the net interest income. So when it comes to Barclays Bank, they only have about 37% of their revenue coming from that net interest income. And this is a positive thing in my opinion, because even though interest rates are likely to increase in the future as the economy starts to rebound, however, the path to higher rates are likely to be a bit more bumpy than we would expect. So basically, we may have some sort of economic recovery coming in the future. The rate increase might not follow that quick, and that's because the Monetary Policy Committee from Bank of England, they want to be sure that the consumers in the UK are actually confident in spending, so inflation comes through and sustains at a positive, say 2% level, and people are actually going to be okay with a higher interest rate scenario. So I think that's gonna be a long way to come. So less sensitive a bank is to that interest income, the better position I think they will be going forward. Another reason why I bought Barclays is because they are basically not loss making. So over their Q3 earnings, they have mentioned a 2.4 billion of profit year to date, which was great. And when you kind of compare that number to the current valuation that they're trading at, so their book to price ratio is well below 1, which means they are trading at a very extremely cheap valuation. And compared to that, given they're still making profit at that level, it seems like an opportunity to sort of have some exposure in it. If I look, I think their current PB ratio is at 0.25. Yes, it's way below 1. So remember, the lower the number, the cheaper it is. So I basically don't think the intrinsic value of this bank would be at 0.25 PB. It's likely to be a bit higher. So hopefully there will be some re-rating. And from Bank of England, they have also told bank that they can start to reinstate dividend payments from these years onwards. So I think Barclays will start to pay out dividends sometime soon, and hopefully we'll have a healthy pickup from that as well. The next company I have is Blue Prism. This is also a new buy over January. I got 100 shares of this company. It's a small cap AIM listed company, and as you can see, when I do invest in stocks in the UK, they tend to be small cap or AIM, because as I've mentioned, I do tend to invest in a bit more riskier stock, and just so that they can have a bit of higher potential on the upside. And that sort of investment mainly comes from stocks that are small cap or those that are not well reflected by the market, because more analysts that covers the stock, the more kind of controlled is the price targets. So in an efficient market, large cap companies tend to have more information that are easily available to everyone, which is why you don't get a lot of opportunity to get a huge upside from those stocks, because informations are captured very efficiently. While for AIM stocks or those that are small cap, they don't have the same level of information efficiency, so you can get a bit more pickup from these stocks. Anyway, I've bought this stock right after their last earnings released, when the share price dropped like 25%, and that was on the back of the company revising their financial outlook for 2021. So they have basically revised their expected earnings downward for a bit, and that really spooked the market, even though the top line number for Blue Prism was pretty solid. And so it seems like a over market reaction to me, and that's when I kind of got interested to look into it. I was aware of this company though from a couple of years ago, when I used to work in another company and I used to cover small cap funds, and this company was held in those funds. So I did kind of look into it before, and I was aware of that company. So when I saw it drop so much, I kind of got interested to dig up some numbers, and I did some quick analysis, and I thought I'll go for it. So this company, they mainly do automation, and their clients are large blue chip companies who wants to automate their back office tasks. So coronavirus was and is quite troublesome for this company, because if you think of all the large blue chip companies, for them, working with Blue Prism is like an investment, and companies would only put money towards an investment when they're sure of how their own company is doing. So with all the uncertainty with coronavirus, a lot of blue chip companies are holding back on investments, which is obviously not great for Blue Prism at the current moment, and that's particularly why they have revised down on their sales. However, I think that when we do start to see some economic recovery, and when blue chip companies are a bit more certain about their outlook, they will want to prioritize this kind of investment, because when you invest in automation, any form of automation, over the long term, they do save you money. So I think this is an area that will pick up on the demand when we start to sort of go through the recovery stage. From this investment, I'm hoping, well, I'll be happy with a 30% return from here. So as you can see, I did buy it at the dip, and since then it started to trend up. So I hope it carries on trending up and I can realize some of those gains. Next we have Fastly. It is up nearly 60% so far, with negative 6% coming from FX. And then we have IDX Laboratories up 12% and negative 4.7% from FX. I spoke about this company in a bit more detail in my last video, so if you want to know a bit more about it, you can check that out. Next we have IG Design. It had a great recovery, but recently started to get a bit weak. But I'm still happy to hold it. Analysts that covers this company, they have started to upgrade their revenue from this year. So hopefully recovery on this company will start to pick up again. Next we have Microsoft. It's up 15% and negative 5.7% from FX. Next we have Nvidia. It's up 9.3% and FX at 5.8%. So yeah, strong pound is really hurting my portfolio, as you can see. But this trend in FX is here to stay for some time. I think it's likely to continue because the dollar is getting weaker for various reasons, and pound is getting a bit stronger, especially after having the Brexit deal. So this is likely to stay. So I should stop looking into it and worrying too much about that. But anyway, Nvidia is going through some regulatory scrutiny at the moment from UK because of its $40 billion of acquisition with ARMS Group, which is a UK-based chip designer. So this deal will be Nvidia's top strategic play, you can say. It will really help make Nvidia this premier computing company at this day of digitalization. So many are actually against the deal, so they don't want Nvidia to take over ARMS Limited. And that's because ARM is as I've mentioned, is a UK-based company, and people are worrying that Nvidia might close UK, place or the headquarter and move it to US. Although Nvidia did promise that they will keep the UK business open, so ARMS intellectual property will continue to be licensed in the UK, and they've mentioned wanting to keep UK's head office in Cambridge as this center of excellence in the AI business. So I'll be keeping a close eye on it because I'm not sure which way it will go, but Nvidia on its own is a great company or a great investment to have anyway. So next we have RWS Holding. It's another AIM company. It's up 11%, and my price target for this is £6.50. After that we have Shopify up 37% and negative 5.8 from FX. And then we have Snowflake 24%, negative 5.3 from FX. And then I have my third buy of January, which was TSMC. I covered this company in one of my previous videos of stocks to hold for 2021. So I want to go into detail as to why I bought this stock, because I think I've explained it in that video. So you can check that one out. But my plan with this company is to carry on buying as it dips or into the weakness, because at the moment the valuation is extremely high. It's quite stretched, so it can come under a bit more pressure, and if it does, then I will kind of continue to buy, because I think this is a really great company and the demand for chips will be great going forward, and so it's going to be a solid investment, I hope. After that we have Tesla up 112% and then 5.9% negative from FX. I'm holding on to it. I'm not selling out, even though I can take my money out of it because it has returned me my initial investment, but I think it's okay to sort of hold on to it, see where it goes, and even if it kind of corrects 20% or so on, it will still be a good profit margin. But as a long-term holder, I think I can hold on to this for a bit more longer. After that we have Trade Desk up 48% and negative 5.9% from FX. So this is the last stock in my current investment portfolio. However, as I've mentioned, I also sold out of some of the stocks. So in January I sold 3 companies that have met my price target. Firstly, Twitter, I sold at 17.4% return. I bought it at $49.95 and sold it at $54. I have also sold Softcat at £14 after buying it at £11.48. So in between that, they have also paid me a dividend of £6.30. So my total return was 24%. And finally, I have sold Wayfair at $300 each after buying it at $257. So 13% return, which is okay. I started to get a bit more cautious with Wayfair, to be honest. Only the medium-term outlook versus the valuation that is kind of currently trading at. I think the stock price again dropped to $289, so I'm happy that I got out of it. It wasn't exciting me anymore because I couldn't see a clear picture of it kind of breaking through 300 at a sustainable level going forward. So yeah, basically I have rotated my investments out of these 3 companies into Blue Prism, Barclays and TSMC. So yeah, let me know if you hold any of the stocks that I have mentioned. I would love to know. And yeah, that's all for now. Until next time, look after yourself and